I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on unusual lows, they push them on unusual highs. For someone that can sit back and have their own opinion, know something about industry, this is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 Whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, you know, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, you know, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics on the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know what hotel occupancy is about. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae, or I own a housing stock. These are facts. There are economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. It's, you need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product if you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha. But you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two. And they have all kinds of arcane methods of approaching that. But they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
So Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth. And I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about. And that may be too bad, but, why should I know all about them? I haven't worked that hard on them. In the securities business, You literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients will start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics, you mean professors of
right,
finance?
The data is there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Go through that strategy and go through how it works, and when you come, maybe you'll override that portfolio manager or not, but what's the checklist you kind of go through?
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount. And once we understand the reasons, we decide, well, these things that we can solve. Or can we, in light of the situation, the circumstances, can we be influential in changing these levers that can cause this valuation discrepancy to narrow? And is this a business that, while we're causing the valuation discrepancy to narrow, we can also perhaps contribute to the valuation growing? And if those things are true, we found something that looks quite interesting for us.
And usually this investment philosophy, does it take a week, a month, 3 months to do the research, a year? I mean, you have 10 names. How long?
It depends. I mean, one of the best investments we ever made, it took us 4 hours to do the work. It was during the financial crisis.
Which was that?
Wachovia Corporation.
Okay. So
I was on my BlackBerry eating breakfast at the Brooklyn Diner in front of my building, and there was a story went across the, I was just, Wall Street Journal headline, Reuters headline, excuse me, went across saying, that Citigroup to acquire the Wachovia banking subsidiaries for $2 in Citigroup stock. Stock was halted. And this was kind of an interesting transaction because they were buying the subsidiaries for Citigroup stock. I figured, this is interesting. What happens to the holding company? So I went back to the, kind of went upstairs to the office and cracked open the 10K, and another member of the team, Mick McGuire, he and I worked on it. And what was interesting is the 1,000-page 10K of Wachovia Corporation, I think 900 pages were on the banking subsidiary. There was fewer than 100 pages on the holding company. And by buying the banking subsidiary, Citi was leaving a holding company which had cash, in Wachovia Securities, A.G. Edwards, they had paid $6-7 billion for it 6 months before, Evergreen Asset Management, and they were taking a $27 billion loss on the sale of the subsidiary. And It also had a liability called non-cumulative perpetual preferred stock, which if you ever want to have a liability in your life, this is the single greatest liability to have. It's a form of equity where you never have to pay a dividend, and when you don't pay them, they don't accumulate. And the worst case is they get a couple directors on the board, and you say hi to them each meeting, and you have this very, and I said, look, this could be our Berkshire Hathaway. And at the end of the day, we figured the asset, in 4 hours we determined the holding company was worth at least $11 to $14 cash, a tax refund that you could carry back the $27 billion loss, recover cash taxes that have been paid. So you have this cash vehicle. You own Wachovia Securities, which is a good wealth management business. You own A.G. Edwards, another interesting asset. These are businesses you know well. And the stock opened after it was halted at $1.84. So we said, look, it's worth 11 to 14, $1.84. We bought 42% of the volume for the next 4 days. And then it was acquired by, then Wells came in and put in a topping bid of $7 in Wells Fargo stock, which wasn't actually a topping bid. But the Wells Fargo deal did not require government assistance.
Right.
So I think Sheila Bair liked
I remember that.
liked
I
that deal better.
actually interviewed Sheila Bair.
Sure.